Good morning, friends. Welcome to Adda 24/7. We are in Achievers MCQ series for BFM, and the topic is objective questions on risk management in BFM. Now, risk management is an important topic in Module B for BFM. Very important because entire BFM, passing and failing depends on this risk management. So, follow this video till the end. Okay. Firstly, download Adda 24/7 app on your mobile. In this app, you will be getting all the premium study materials plus live classes, ebooks, tests, whatever you need for clearing CAIIB, you will be getting it over here. So download it as app. Also, subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting two things. Number one, all the latest updates on JIB and CAIIB, and number two, importantly, free YouTube series on various subjects. Free, whatever is free, grab it fast. Subscribe to this, click on the bell icon. Okay, these are the two new batches we just now started. Okay, join these batches ASAP. All the four subjects are covered: ABM, BFM, ABFM, BRBL. Okay, all the four subjects. Importantly, 80% off is going on, and double validity on Mahapacks is going on. Huge discount. 80% is a big discount offer. Okay, you never get it every now and then. Use the code Y432. How to use it, I'll show you at the end. Okay, yesterday's homework. This is yesterday's. Let me write it because I had kept it. I didn't write it over here. This is yesterday's. I'll write it. Yes, yesterday. What did I ask yesterday? See here. Which among the following institutions have to maintain CRR? Who has to maintain CRR? Scheduled commercial, NBFCs, urban cooperatives, or state and central cooperative societies. So the correct answer options were A, B and C, means scheduled commercial, NBFCs and urban cooperatives. A, C and D, scheduled commercial, urban cooperatives and state cooperative societies. Only A and C. So the correct answer is only A and C. Why? Only banks are required to maintain this CRR. A and C, scheduled commercial banks and urban cooperative banks. Okay. So that was the right answer. Let's move on. See here. The balance sheet risk may result in. So topic is risk management, right? So the balance sheet risk may result in. So balance sheet risk means what? What is balance sheet risk basically? See here. What does the balance sheet contain? It has assets over here and liabilities over here, right? So if any mismatch is there between the asset and liabilities, then definitely I'll be facing the balance sheet risk, right? So interest rate mismatch risk. So what happens due to if there is a mismatch in the assets and liabilities? What happens? Suppose what are there in assets? Okay, we have loans over here for banks. I'm talking specifically for banks. Asset means loans and liabilities means deposits. Okay, keep it very simple. Let's keep these two elements only. Suppose if I am having more loans and lesser deposits, then what does it mean? It means number one, I'm earning more because loans means I'm getting the interest. Deposits means I'm giving the interest. So I'll be earning more. So it's beneficial for me. But there is the risk involved over here. The risk involved over here is if I have more loans and lesser deposits, where will I fund these loans from? Because this loan needs money to be given. That money comes from deposits. Okay. So that's why both should always be balanced. If there is a mismatch over here, then we'll definitely face which risk? Interest rate mismatch risk, liquidity risk, foreign exchange risk, and all of these. Which will I face the main? Or is it all of these? It can be all of these. I'm not saying no. So it can be interest rate mismatch risk, it can be liquidity risk, it can be forex risk, and all of these. So what do you think? Type fast in the comment section. A, B, C or D. Everyone. Okay, I'll explain you one by one. Okay, the answer is actually D, all of these. Suppose if I have mismatch in my assets and liabilities, there will be a interest rate mismatch risk. Suppose if my assets are lesser and liabilities are more, then I'll have to give more, so I'll be facing interest mismatch risk. Similarly, if my assets are less and liabilities are more, I'll be facing the liquidity risk because going interest is higher than coming interest. Forex risk, definitely forex risk also, because being a bank, I can't say today that I am not holding a forex risk, at least for commercial banks. I have to maintain the foreign currency. So if there is a mismatch in the foreign currency assets and liabilities, I'll definitely face this risk. So the answer is all of the above over here. Okay. Which of the following is not a transaction risk? What is transaction risk? Transaction risk means it's related to transactions. Whenever I do the transaction, it can be the counterparty may not pay. So which of these can be considered as a transaction risk? Mismatch in assets and liabilities portfolio, credit risk, price risk, and instrument risk. Now which of them is not a transaction? Here the question over here is not, okay, which is not a transaction risk. So mismatch in assets and liabilities, can it be there? Credit risk, can it be called as a transaction risk? Price risk and instrument risk. See here, all these elements are related to transactions over here. Assets and liabilities are related to transaction. Price is related to transaction because transaction risk will depend on the price. Similarly, any instrument, if the instrument fails, then what? But what is not a part of transaction risk? That is credit risk. Remember, credit risk is totally different. Credit risk consists of two parts. Always remember, credit risk consists of two parts. One is country risk, country, okay, and second is counterparty, okay, counterparty. I'll write it over here so that you understand this and you remember this also. Counterparty risk, okay. Credit risk consists of two parts only, okay. So credit risk relates to the counterparty not paying due to any reason, due to his the counterparty's country may not be allowing it to pay. It can happen like in Afghanistan, okay, country doesn't allow, or in 90s we had the same in Pakistan, okay. So these things can happen. The features of price risk are, means price risk. What are the features? Price risk means the price going down. When will the price go down? Sure, the price risk, what is said over here, it means it relates to bonds, okay. Bonds, always remember the logic of bonds. If the interest rate, asking rate goes up, interest, okay, or yield we call it. If the yield rate goes up, interest or yield we call it, YIELD, yield. If yield goes up, the price goes down. Always remember, it's in the inverse proportion. The features of the price risk are, it includes risk of loss due to change in value of the assets and liabilities. So it may include the risk of loss. If my price goes down, then what? It also includes the market risk due to fluctuations in the price of the assets in the market. So does it include the market risk? Means what is market risk? Market risk means any risk which is not in your hands. So this price risk, is it in your hands? The asking rate of the bonds, is it in your hands? Okay, I'll give you an example. October 2022. October 2022 to December 22. Just December, okay, 22. Just 2-3 months back. Have you seen the interest rates of the bonds? It was too high. US and UK, they were gone, skyrocketed. So was it in your hands? No. Because of these bond prices, what happened? All the stock markets in India also fell. So that is market risk. Market risk means which is not in your hands. So price risk may relate to that also. It includes market risk due to fluctuations, okay. This may happen on account of the issuer risk, which depends on the financial strength of the issuer. Now price risk means what here? Issuer risk. I'll give you an example over here. If anyone knows Lehman Brothers, and just type yes if you have heard of Lehman Brothers or the crisis which was there in Lehman Brothers. Have you heard of that? Okay, why to go long? Have you seen that 2017-18 Yes Bank crisis? Yes Bank, all the bonds gone down, isn't it? So these crises, these things happen due to the issuer's risk. This is called as issuer's risk, okay. So this may happen due to issuer's risk, always remember, which depends on the financial strength of that issuer. So the question over here is, the features of price risk are loss due to change in value, it can be. Market risk, it can be. Issuer risk, it can be. The answer is D, all of these, okay. Means price risk can happen due to market conditions, due to issuer not being able to pay, okay, or due to change in the means basically balance sheet risk, okay. Which of the following contributes to the instrument risk? Instrument. What is instrument risk? Suppose I'll give you a simple example. You have some FD of some, example I'm giving, some cooperative bank which is very small cooperative bank. You're having the FD of let's say 12% per annum. Do you know many of the cooperative societies and banks give you 12% per annum for FD right now also, even now. Whereas we are where half of this, 6% we are there. So if you are having that FD of that cooperative bank, then tomorrow if that cooperative bank fails or defaults, is there any use of this FD? No, right? This 12% is of no use, isn't it? So that's what the point over this is known as instrument risk. Suppose if you are holding the 1000 rupee note now, which was there before demonetization 2016, is that note of any use now? So that's an instrument risk. Okay. So which of the following contributes instrument risk? The nature of hybrid instruments in the market. Hybrid. What are hybrid instruments? Hybrid means those can be converted from equity to debt or vice versa. Both of them. See here, I'll mark it like this. Vice versa. Equity to debt or debt to equity. Both of them can be converted. So nature of hybrid instruments in the market. Fluctuations in the market conditions. So is this due to the fluctuations? Means instrument risk can be due to the fluctuations in the market risk? Don't know. You have to answer it, isn't it? The price of various instruments may react differently from one another. So is this an instrument risk? Now that's what you have to think. See here, one or two answers have been all of these. Now is this the third answer also all of these, or is this something else? Now this is what you have to think logically. Hybrid instruments, yes, answer. Fluctuations in the market conditions, due to that, is this due to the instrument risk is caused due to that? Or prices of various instruments may react differently from one another. Which of the following will contribute to that instrument risk? All of these? Correct answer is only A. Okay, because B is a market risk, market fluctuations. C is a portfolio risk, portfolio, various instruments. Okay, so I've seen many of you typing this D, but the correct answer is hybrid instruments. Only instruments nature of equity or debt will affect that this instrument risk. All these remaining risks are related to other things. Okay. Now before going ahead, let me come back to these batches. Okay, just now started. All the 4 subjects are covered: ABM, BFM, ABFM, BRBL. Also you get the recorded videos of the electives. Okay. So all the 4 subjects, in fact I would say 5 subjects. So you are getting what? 80% discount on the batches plus double validity on Mahapacks. Numericals, objective questions, case studies, everything is covered. 80% discount, double validity on Mahapacks. You use the code Y432. How to use this code? Okay, let's watch till the end. At the end I'll show you how to use this code. Okay, now don't jump to the end because these questions are important for you. Okay, which of the following is not market liquidity risk? Now what is this liquidity? Call it only liquidity, forget this market, because liquidity risk arises in market only. So which of these is not a liquidity risk? Lack of liquidity of an instrument or asset in the time. See here, these words are seemingly difficult, but remember you will get answers in the question of this nature only. Lack of liquidity of an instrument. We want not. Remember this. We want not. Okay. Always in the exam, you always have to focus on what you want. Do you want liquidity or not liquidity? Okay. Lack of liquidity of an instrument or asset in time. The financial strength of the instrument. The loss may occur due to fluctuations in the market price at the times of liquidating. Okay, and all of these. So which of them is not a liquidity risk? Lack of liquidity of an instrument or asset in time. Financial strength of the instrument. The loss may occur due to fluctuations in the market price. So fluctuations in the market price means the price may go up or down. Okay, so is this related to liquidity risk? The price of that market may go up, of that instrument may go up or down. This may cause the liquidity because it's at the time of liquidating we are talking. So liquidating means at that time it will definitely affect my finances over here, because at the time of liquidating, if the price of this bond goes down, then what happens? Okay, so the correct answer over here will be D, all of these. Lack of liquidity of an instrument or asset in time means whenever I want it, if the price is not as per my requirement, then I am facing a liquidity risk. Financial strength of that instrument, if the strength is gone, means the financial strength means basically issuer, okay, issuer company. Like what happened to the Adani bonds in the recent problem which we had seen, Adani bonds, okay. I'm just giving you this example. I'm not for or against Adani anything, okay. So what happened to this? This was the financial strength, okay. Means the market, the bonds went down, okay. But now what is happening? They are coming up. Always remember, okay. So that's why the topic is totally separate. If you want to discuss on Adani's issues, we can discuss it for 2 hours right now, okay. But this is not the topic today. So the financial strength of the instrument issuer, that's okay. Loss may arise due to fluctuations at the time of liquidating. So that's also liquidity risk, because at the time of liquidating, if the price of that bond is less, then it's similar to that of A only, isn't it? Then I'll be facing the problems. Risk arising from adverse business decisions. Now what is this business decisions? Improper implementation of decisions, lack of responsiveness to industry changes is called as what? Reputation risk, strategic risk, operational risk, management risk. So what is the correct answer over here? Risk arising from adverse business decisions. Focus only on this part. Forget remaining parts, okay? Improper implementation, lack of responsiveness, that is also a point. Adverse business decisions means what? Lack of responsiveness, isn't it? It means that only. So what do you mean by this? Do you know? Okay, I'll explain you with some examples, okay? What was the, let me get it, one example. Nokia. Nokia was a leader in phones, right? Mobile phones in 2004 to 2007 roughly, 8. After that what happens? Today do you have Nokia? How many of you have Nokia? Just type yes in the comment section if you are having Nokia phones. I am not seeing many, not even a single person is having Nokia now. Where is Nokia gone? Leader, where is it gone? Gone. Why? Why gone? Gone because it didn't respond to the markets. Market was moving towards Android. Okay, at least in Asian countries, okay, market was moving towards Android and iPhones. But Nokia kept on the same old platform. That's why vanished. Where is that Kodak company? Anyone remember this Kodak? What is this Kodak? Kodak was once a leader in the film business. Now film's gone, mobiles came, no film is required for the photos, right? Or any shootings. So gone everything. Everything is electronic. You don't respond to this, then you are gone. Okay? So these are the main examples. Many others are there. You can go for many others. Many of the banks also, I would say. Means banks were not geared up earlier, but then after 2005 or 2010, all these nationalized banks geared up, and now they are in tough competition with these private banks also. Why? Because they looked at the business decisions correctly, responded to the markets correctly, and this risk is known as what? If you don't respond, so that is known as strategic risk. Strategic means you don't do a long-term thinking properly. The other name to this is business risk. I'll just write it. Business risk, okay? That is also known as strategic risk. Got it? Reputation risk, which arises from negative public opinion, may result in means. Reputation risk means what? If some news tomorrow comes out of your bank, that this bank has NPAs have gone high, RBI has put a regulator on that or administrator on that. So immediately all the papers will print it. Negative news spreads faster now. Always remember this word. So which arises from negative public opinion may result in what? Exposing an institution to litigations, financial loss, decline in customer base. All of these. Obvious answer, very simple answer. Litigations means court cases, it may come. Financial losses, it may come. Decline in customer base, it may come. So the answer is, it may come. All of these, isn't it? Answer is all of these. Okay. Yeah. Now one for your homework. Risk associated with the portfolio is always less than the weighted average risk of the individual items in the portfolio. Due to means, what do you mean by this question? If I put 1 lakh over here, see here, if I am having 1 lakh, if I put it in only one share, let's say Reliance, okay, only one company share, Reliance. So is this better, or I put 1 lakh in 10 companies, 10,000 each? So is this better or is this better? That is the real question. Okay. So always less than the weighted average risk of the individual items. Why? Because of diversification of risk, fact that all accounts in the portfolio will not behave in the unidirectional manner, the fact that risks in all account in the portfolio will not materialize simultaneously. I'll explain the meanings tomorrow. Okay. Materialize means what? I'll just give you the hint. Materialize means it's a call risk. All these bonds will come for payment immediately. Will this happen? That's your call. Okay. I'll answer this tomorrow. A, B, or both A and B. Okay. So let's see. Okay. So which is better over here? You just answer as per your logic. Okay. Now let me show you how to use this code Y432. In these batches, I'll again tell you, join these batches ASAP. Because portion is new, you will be needing a mentor. Okay. A guide. And we are covering all the important case studies, numericals, objective questions on all the compulsory 4 subjects. Okay. And also on the elective. So 80% off, double validity on Mahapacks, so 15 plus batches per subject. How to use the code? Let's go. Let me show you. Okay. Okay. Let's go to Adda 24/7 app. If you are having the app, I would suggest go on the app, isn't it? So go to Adda 24/7. Let's go live over here. So this. Now you are on the Adda 24/7 website. If you are having the app, go on the app. Okay. Click on JIB and CIB. Now you will see this CIB 23. Click on CIB 23. See this. The batches you will see over here. Click on this English batch. Just now started. Click on this. You will see the details. If you miss out on any class, you can get the recorded videos. But obvious. You will see the details means what are the timing, dates, etc. Okay. Importantly, I will tell you, recorded videos are available 24/7. E-books are available. Tests are available. 2-way interactive classes. So you can ask the questions there and then itself. Live classes. So that's an advantage. Okay. What is the fees? 23,999. Click on view offers. Put the code Y432. Y432. Click on apply. Look at this. 23,999 reduces to 4,799. 80% off. Such a huge off you are getting. On Mahapacks, let me show you Mahapacks. 15 plus batches for Mahapacks. Let me show you Mahapacks. Okay, go for Mahapacks. I will always suggest you to go for Mahapack. In Mahapack, click on again, go to the front page, click on JIB, CIB, JIB, CIB, Mahapack. Okay. So now, click on this CIB ka Mahapack. In this Mahapack, you will get the details. See this. The details are these. 15 plus batches for ABM, BFM, ABFM, BRBL. Or means CIB 15 plus batches. Case study batches are there, tests are there. What all do you need? Live classes, ebooks, everything is there. 2-way interactive classes, and per subject 15 batches means if you attend one means this 15 batches for each subject, you need not even learn. You'll learn it by in the classes only. So click on view offers. 35,996 reduces to, look at this. Okay, put the code Y432. Y432. Click on apply. Look at this. 35,996 reduces to 7,199. 80% off. Okay, and validity. Look at this. 12 months validity. So 12 months, 7,199. Divide it. Everyone divide it. 7,199 by 12 months. It is less than 600. Let's round it off to 600. Divide the 600 per month into 30 days. It comes to what? 20 rupees per day. Isn't it? How much do you spend on teas, tea breaks, or going here and there during the this bank timings? Okay. So there we spend more. 20 rupees per day will give you the returns for the lifetime. Join it ASAP. Okay. Why am I stressing on the batches? Because look at this. The portion for CAIIB has changed. What is the new portion? See this. Many of you might be knowing, but those who don't know, okay, The new portion has 4 compulsory subjects: ABM, BFM, ABFM and BRBL. Look at the portion also. Okay, retail elective, no retail elective. That's why you'll be needing the guide. Rural HR, IT, central banking and risk. No retail. Negative marking has been removed from May 23 at least. So it's a good sign for you. Join the batches ASAP. I'll be coming back tomorrow.